Here's a harsh truth most first-time buyers don't realize. You can fall in love with the perfect house and still lose it because you weren't pre-approved. In 2025, sellers want to know you're ready, and that means having your financing locked in before you even tour a property. I'm Matthew Hall, a real estate educator and former account executive at the #1 mortgage lender in the country. I help first-time buyers all over the United States make smart, confident decisions that save them money and stress during the home buying process. Here's what we'll cover today. What a mortgage pre-approval really means, what lenders look for and how to qualify, the exact documents you'll need, how long it'll take, and the biggest mistakes that can ruin your approval even after you get it. So first, what even is an approval? Let's start with something simple but important. A pre-qualification is not the same thing as a pre-approval. A pre-qualification is just a soft estimate based on numbers you tell a lender online. It's not verified and it carries no real weight when you go to make an offer. A pre-approval, on the other hand, is a verified commitment. It's a formal letter from a lender that says, we reviewed your credit, your income, and your finances, and we're willing to lend you up to this amount. This letter shows sellers and real estate agents that you're a serious buyer. Now let's talk about why that matters. First, it tells you exactly how much home you can afford. Second, it makes your offer stronger because you've already done the financial work. And third, it speeds up the process once you find a home you love. The bottom line is this: without a pre-approval, you're just browsing. You're not a serious buyer that sellers will take serious. Now let's talk about what do lenders even look for to approve you. Lenders review 4 major areas when deciding whether to pre-approve you or not. First is your credit score. For FHA loans, you'll usually need a 580 or higher. For conventional loans, the minimum is around 620, and for the best rates, aim for a credit score above 700. Second thing they look at is your income stability. They want to see a consistent 2-year job history in the same field or industry, even if you've changed employers during that time. Third, they calculate your debt to income ratio, also called your DTI. That's the percentage of your monthly income that goes towards debts like credit card, student loans, and car payment. The lower your DTI, the better your chances. Most lenders want to see it around 43%, but some will go higher depending on the loan program. And fourth, they look at your savings and assets. You'll need enough funds to cover your down payment, closing costs, and ideally a small cushion after closing so you're not financially stretched too thin. Now, let's talk about what documents do you need. To get pre-approved, you'll need to provide a few key documents. These documents will help lenders verify that you are who you say you are and that your financials are solid. Here's what most lenders will ask for: 2 years of your recent W-2s or tax returns, the last 30 or 60 days of your pay stubs, 2 to 3 months of bank statements, a valid photo ID, and your social security card. If you're self-employed, you'll also need your business tax returns and a year-to-date profit and loss statement. Having all of this ready before you apply makes the process go way faster because it gives your lender everything they need to approve you with confidence. Now let's talk about how long does it take to get pre-approved. Once you submit your application and all your documents, most lenders can get you pre-approved within 24 to 72 hours. Some lenders can even do it the same day, but that depends on how quickly you provide everything they need. Your pre-approval letter is typically valid for 60 to 90 days. After that, you'll need to update your documents or reapply, especially if your financial situation has changed recently. Now, let's talk about what can ruin a pre-approval. Getting pre-approved is great. Losing that approval before you close on a home, that's where things go wrong fast. Here are the most common mistakes that can ruin your pre-approval before you close on your home. Don't open any new credit cards. Don't finance a car or make large purchases on your credit. Don't switch jobs unless you absolutely have to. Don't move large sums of money between accounts. And don't co-sign a loan for anyone else, no matter how much you trust them. Lenders will recheck your credit and finances right before you close. One wrong move can delay or even kill the entire deal. Okay, so let's recap. Getting pre-approved is the first real step to becoming a homeowner. It shows sellers you're serious, helps you shop with confidence, and can save you major time and stress once you're under contract. To get pre-approved, focus on your credit, income, savings, and debt. Avoid big financial changes during the process and work with a lender who knows how to guide you through it. If this video helped you feel more prepared, give it a like and subscribe. I post new videos every week to help first-time buyers make smart, confident real estate moves without the guesswork. Have a good one.